In an era where financial literacy can make or break your future, understanding the maze of available loan types is not just smart, it's essential. Every day, millions navigate this labyrinth, making decisions that will affect their lives for years to come. Whether you're eyeing that shiny new car, dreaming of a home, or aiming for the hallowed halls of academia, knowing your way around loans could save you from financial pitfalls and lead you down the path of fiscal stability. But how do you choose the right type of loan? And what are the traps to avoid? It's no secret that loans can be both a boon and a bane. The right loan can be a stepping stone to fulfilling your dreams, while the wrong one can turn into a financial nightmare. This comprehensive guide will demystify different types of loans, highlighting their benefits and downsides, and provide real-life examples to clarify complex concepts. Let's empower you to make informed decisions that lead to a prosperous financial future. Personal loans are unsecured loans provided by financial institutions that can be used for a variety of purposes, from consolidating debt to funding an unexpected medical expense. Unlike other types of loans, they do not require collateral. One major advantage of personal loans is their flexibility. You can use them for almost anything, which makes them incredibly useful in situations where specific use loans like auto or mortgage loans won't suffice. However, this flexibility can also be a downside, as it might tempt borrowers to take loans for non-essential expenses. Ideal scenarios for using personal loans include consolidating high-interest debts or covering urgent large expenses. A real-life example is Jane Doe, who consolidated her credit card debts into a single personal loan with a lower interest rate, helping her save money and pay off her debt faster. A real-life example is Jane Doe, who consolidated her credit card debts into a single personal loan with a lower interest rate, helping her save money and pay off her debt faster. Auto loans are secured loans specifically designed to finance the purchase of a vehicle. These loans are typically tied to your car, which serves as collateral, meaning the lender can repossess the vehicle if you fail to make payments. The main advantage of auto loans is that they make it possible to purchase a car without paying the full price up front. This can be crucial for individuals who need a vehicle for work or family life but don't have sufficient savings. On the downside, the interest and fees from auto loans can add significantly to the total cost of the vehicle. Auto loans are ideal when you need a vehicle and can't afford to pay outright. For example, John Smith needed a car for his new job, which was not accessible by public transport. For example, let's talk about John Smith. He needed a car for his new job, which, unfortunately, was not accessible by public transport. To overcome this challenge, he took out an auto loan, which enabled him to buy a car and, ultimately, take the job. Now, let's move on to mortgage loans. Mortgage loans are used to purchase real estate, with the property itself serving as collateral. This type of loan is crucial for most people looking to buy a home, as the cost of real estate is typically beyond what most can pay up front. Mortgages can have various structures in terms of interest rates and repayment terms, which can be both a pro and a con. They allow you to own a home while spreading the payments over many years, but they also commit you to long-term debt. Misunderstanding the terms can lead to overcommitting financially. The optimal use of a mortgage loan is when purchasing a home you can reasonably afford, considering your income and other debts. Optimal use of a mortgage loan is when purchasing a home you can reasonably afford, considering your income and other debts. Sarah and Bob Jones used a fixed-rate mortgage to buy a home, avoiding surprises with fluctuating payments and ensuring stability. Student loans are designed to help students pay for post-secondary education and the associated fees, such as tuition, books, and living expenses. These loans can be federal or private, with varying terms and conditions. The benefit of student loans is that they enable access to education that might otherwise be unaffordable, which can lead to better job prospects and income in the future. However, they can also lead to substantial debt burdens if not managed wisely. Student loans are ideal when they are used to finance an education that is expected to increase the student's earning power. For instance, Lisa Nguyen took out student loans to attend medical school, an investment that greatly increased her income potential. For instance, Lisa Nguyen took out student loans to attend medical school, an investment that greatly increased her income potential. Loans are powerful financial tools, but they carry responsibilities. By understanding the different types of loans, their appropriate uses, and the potential pitfalls, you can make informed decisions that bolster rather than hinder your financial future.